And welcome to our very special edition of our Understanding Credit and Managing Debt. My name is Alana. How is everybody doing today? If you are listening to me right now on YouTube or anywhere else like that, restream, just type in the chat box on the side. How is everybody doing? I hope everybody can hear me and see me properly. This is a new platform that we are using. Good afternoon from Ontario. Hello, Miss Marie. Ontario where? I'm in Toronto. So very nice to see you. Yeah, whereabouts in Ontario are you from? It's a beautiful day today. Oh my goodness. I just put my RV away a couple weeks ago and I'm kicking myself now because I probably could have spent all of October in it because our weather has been incredible. So we've got a couple people here from Nova Scotia, Ontario, Three Hills, Alberta. Hi, hello. We get people across Canada in these webinars, and I love it. Toronto, also great. That is awesome. Welcome everybody to our. Oh, now we got everybody coming. We got Brampton, we got Winnipeg, we've got Toronto. We got lots of people coming in from all over the place. Hello, welcome. Thank you for joining. My name is Alana Abramsky. I'm the head of financial coaching with Enriched Academy. I'm going to be your host today. I'm going to go through a webinar about understanding credit and managing debt. So for those of you who have never been on our webinars before, if you have any questions about anything that I'm going through throughout the webinar, please ask your questions in the question box, that chat box on the side, and I will get to them at the end of the presentation. So I'm going to try to get to as many questions as I can and answer as many questions as I can. But while we are here and while we are ready to go, and it is 1 o'clock, I know there's a couple other people coming in, which is normal. Let me introduce myself for those of you who do not know. As I mentioned, I'm Alana. I run the head of financial coaching with Enriched Academy. I've been working with Enriched Academy since October of 2017. So I'm just coming up now to my it'd be my fourth year. It's been an amazing journey. It is really incredible to see just how much this company has evolved since I started with them 4 years ago. And I remember the first time that I met up with the team at Enriched, and it was at one of their live boot camps. And I had always had a really strong passion for personal finance, and met the team at Enriched, and they were practicing and preaching. They were more so preaching everything that I was practicing. And I basically, hounded them for a month for a job. Then they hounded me for a month for a job, and we were back and forth. And here I am today, 4 years later, running the coaching program. I've got 3 coaches that I'm overseeing. I work with my own clients. And, we see a constant thing that happens over and over again in our coaching program. And it's basically a lack of education. It's at nobody's fault of their own. It's just, it's not something that our system really discusses with people, as different ways that we can better our financial health. So I'm going to teach you today about understanding credit and managing debt. Now I'm going to start off with understanding credit, and then after the second half of this, we're going to talk about how to manage your debt. But before we talk about how to increase your credit score, I want to go through a couple of facts. 42% of Canadians carry credit card balances from month to month. A first-time bankruptcy will appear on your credit report for 6 to 7 years after your date of discharge. And this is actually a really interesting note to make. We had a client a couple days ago, we had a follower of Enriched Academy who had gone through a consumer proposal, and we've had clients who have come into coaching and they've gone through a bankruptcy. If this is if you have gone through a consumer proposal or you have gone through a bankruptcy, it's very, very difficult to increase your credit score during that time until your release date. And it is just part of, it's unfortunate, but it is just kind of part of the deal. But what we do teach you in these webinars is how to not get back into that situation down the road, right? And I'm going to talk to you about, our coaching program after this and show you the effects that coaching has on clients' individuals' credit scores. Now, here are some really interesting credit card statistics. Back in 1957, there were no credit cards in circulation. And as of today, there are 1.7 billion credit cards in circulation. Now, of that, credit card companies generate over $200 billion per year in interest charges. and fees. That's huge. And the national average credit card interest rate is 16.73%, which is quite high. Okay, now that we've gotten all the facts out of the way, and these are really important things to understand, right? One of the first things that we talk about when clients come into coaching is if they have high interest debts or they have any debts, we want to know what their interest rates are, right? It's really important if you are trying to better your financial situation. You need to know where you stand right now. So if you have debts and you don't know what your interest rates are on those debts, I would highly suggest after this webinar, figuring it out. Call your financial institution, look at your bank statements, whatever. You need to know what your interest rates are on your debts. So now let's talk about how credit scores work, because this is one of the reasons that all of you are all here. Now, credit scores, Canadian credit scores, are officially calculated by two major credit bureaus, Equifax and TransUnion. In Canada, your credit score generally ranges from 300 to 900 points. The higher your score, the better. Now, high scores may indicate that you're less likely to default on your repayments if you take out a loan. And your credit score, at the end of the day, it's your financial report card, and it's calculated through a number of different ways. If you don't know what your credit score is at this point in time, also something that you should figure out, because we have seen that there have been inconsistencies. We've seen a number of different things where, well, I mean, people should just have their credit score. The other thing, and I want to kind of preface this, but having a good credit score, depending on where you are in life, is not the be all and end all. It's very important to have a credit score if you're looking for, and have a good credit score if you're looking to take on more debt, like apply for a mortgage or you're looking for a new car. But if if you're just kind of, I'm not saying ruin your credit score, but having a good credit score is not something that is the be all and end all of everything financial, right? Okay, sorry. So how is your credit score calculated? Your payment history is the most important factor for your credit score. To improve your payment history, always make your payments on time. Make at least the minimum amount, but if you can pay them off in full, definitely do that. And please don't ever skip your payments, even if a bill is in dispute. This activity demonstrates your ability to responsibly manage credit and can have a really positive impact on your credit score. The second thing is the amount owed. To improve in this area, make sure that you don't go over your credit limit and try to use less than 35% of your available credit and use your credit wisely. And if you use a lot of your available credit, lenders will see you as a greater risk. All this basically means is that if you have a credit card that you have a credit limit of $1,000 and you're constantly maxing out your credit card, it's going to look negatively towards lenders and it's going to hurt your credit score. So what you should try to do if you are notorious for maxing out your credit cards, every time that you make a purchase, try to pay off that purchase immediately, or at least try to always, pay off at least, you want to stay below $350 of use on that credit card, or increase your credit limit. Now, if you are going to increase your credit limit, that's fine, but don't take that as a raise or something and just continue to max out your credit card, because that's how people get into debt that they cannot then get out of. The third factor is the length of credit history. The longer you have a credit account open and in use, the better it is for your score. So if you have one of those credit cards that you've been using since university and you're actively using it, keep it open and continue to use it properly, and it's going to have a positive effect on your credit score. The fourth factor is determined by any new credit applications. So if you're looking for too many credit, or if you're looking for too many credit cards, or you're looking for a new mortgage and you're kind of rate shopping, it could have a negative effect on your credit score. And then the fifth and lastly is the type of credit used. If you only have one type of credit product, such as a credit card, it could negatively affect your score. So having different types of credit available is actually going to be a way to improve your score, but just make sure that you are always paying back any money that you borrow. And of course, if you take on too much debt, it could negatively affect your score. So here are some really great examples of the true cost of credit. And these are just different scenarios if you had a poor credit score versus if you had an excellent credit score. And basically at the end of the day, what's going to happen is if you have an excellent credit score, you're going to save a ton of money in interest charges, right? So you can see here, obviously, these mortgage loan rates, this was probably from, well, I mean, this slide is a little bit outdated now because mortgage rates are dirt cheap. But I have an excellent credit score, and I was just quoted for a 5-year fixed mortgage at 2.09%. Now, I have seen better, but that is kind of an idea of somebody who has an excellent credit score. We've had some clients who have come into coaching with a poor credit score, and they're, having to take on first mortgages at 9 to 12% return because they can't get a mortgage through the bank. So it's that kind of scenario. Now, you may be wondering what affects your credit score. So let's go through a few case scenarios. Mortgage, credit card, car, and student loans. Yes, it does. Rent payments. No. Selling utility bills. Yes, if it is with collections. That means if you have not paid them. Insurance payments. No. Bank overdrafts. Yes, if it's with collections. Parking tickets. Yes, if it's with collections. Child support and alimony. Yes. Checking your own credit. No. If you are checking your own credit, it is what's known as a soft pull. So it's just you checking your own credit for more educational purposes. It's not going to have an effect on your credit score because you're not looking for new credit, right? You're not looking to take on new debt. Age and income, no, and credit counseling, no. So we get a lot of clients who come into coaching and they don't have the greatest score. Sometimes we get a lot of clients who come in and they've got great scores, but we wanted to talk to you about the top 10 ways to build an excellent credit score. You want to attack unattractive debt first. So this would be high interest credit cards, financing deals that are very high interest, any of those kinds of debts. You want to try to get rid of those first. You always want to try to maintain at least 2 credit vehicles. Keep longer-term credit vehicles open. As I said before, if you've got a card that you've been using for the last 10 years, keep it open. Aim to use 35% or less of available credit. Ask for the highest available credit limits to assist with your utilization rates. Now, as I mentioned before, if you're going to go this route, that's fine to help with your utilization rates. But if you're somebody who's constantly maxing out your credit cards because you're not being mindful of where your money is going, and you get $1,000 credit limit, you don't want to just continue to all of a sudden max out your credit card at $2,000 every month, right? That's not the whole purpose of this activity. Always make sure you read the fine print. Avoid rate shopping. So this is where you're going to, you go to 5 of the same banks or 5 of the different banks and you're asking each one for a mortgage. They have to pull your credit score every time that you're asking for a mortgage, right? So in that case scenario, you want to talk to a mortgage broker who can pull your credit score once and then shop around kind of for you. Monitor your credit score because many scores have errors. Pay the full amount owing on your debts every month if you can, and always make 100% of the payments on time. Now, a lot of the major banks out there, if you bank with, if you bank with BMO, RBC, CIBC, Scotiabank, I don't know which other one there are out there, but those 4 for sure have an affiliation, or they have a relationship with TransUnion, where if you bank with one of those major banks, do a Google search of how you can figure out what your credit score is through their banking systems. And they actually use TransUnion, so you can go in and see your credit score. It's really interesting. And everybody, as I said before, should do this. Okay, now let's talk about how to manage your debt so that you can increase your credit score over time. And this is one of the big things, when people come in and they're like, I need to increase my credit score, we take them through this whole scenario here. We take them through these activities so that they can actually manage their debt to increase their credit score over time. Okay, first thing, we need to understand the difference between good debt and bad debt. Now, good debt is debt that will grow in value or long-term income. And bad debt typically comes with a higher interest rate and is used to pay for things that lose their value over time. So these types of debts don't generate long-term income. They basically suck the income out of your pockets. So the example would be credit cards, car loans, payday loans, cash advances, etc. So just remember this mountain: good debt appreciates and bad debt depreciates. Now, the average 18 to 25-year-old in Canada is $8,343 in debt. And Enriched Academy is on a relentless mission to help change this. So how do we fix this, right? How do we fix this problem if you have debt or you want to increase your credit score? If you're part of the Enriched Academy online curriculum, I want you to go on and I want you to fill out a net worth tracker. Now, using our net worth tracker or any net worth tracker, whether you're part of Enriched Academy online, the Wealth Mastery course, or not, you can do this at home using a spreadsheet or a piece of paper and a pen. But there's a lot of benefits to using a net worth tracker. Tracking your net worth tracker naturally causes it to grow. Once you create the habit, it becomes very addictive and very productive for growing wealth. And it's very easy to do. Ever since starting with Enriched, I have been tracking my net worth. And I can tell you in the last 4 years that I'm almost 2.5 times the amount that when I started at. And I love doing it. It's actually become a bit of an addiction. I get very excited for the 15th of every month because I can wake up and I can sign into all of my accounts and I can fill out my net worth. Now, Forbes said the net worth is the single most important financial metric that one can track. And I think it's right. I was actually thinking the other day when I was working out, there's a couple of songs out there. I think it's maybe by Nicki Minaj. And she says something like, "What's your net worth?" And I'm like, I bet you a lot of people have no idea what their net worth is. It's a really awesome song lyric. Anyways, this is what our net worth tracker looks like for those of you who are part of Enriched Academy or you're in our coaching program. As of right now, it is only downloadable in Excel, but if you do have Enriched Academy online, we do also have the tool that has been built into the online curriculum as well. So for those of you who are part of Enriched, head online, you can log in with your access code, and then you can download our tools and you can find our net worth tracker under the calculator and tools button, download it in Excel. And then also on that dashboard, you'll be able to see the net worth tracker tool. Now, when filling out the net worth tracker, you're going to sign into all of your financial accounts and add in the current values of your assets and all of your liabilities. Your asset is what you own and a liability is what you owe. Now, I want you to be as accurate as possible with your assets and liabilities because when you're managing your finances, I truly believe that every dollar counts. You're also going to want to include all associated interest rates on any deposit accounts or investment accounts that you have and any interest rates that are associated with your debts. Then you're going to add in any other assets or liabilities that you may have. Maybe that's a car or a boat or, a collection of comic books or anything else like that. And then once you have input all of that data, our spreadsheet is going to auto-calculate everything, and then you can log that net worth for that month. So let me give you an example. This is an example of the net worth tracker that we use with our clients. So I have gone through, and when filling out the net worth tracker, the first thing that you want to do is you want to input the date up here, right? Because this net worth tracker there's a couple of tabs that talk to each other. So the first thing you want to do is fill out the date. Then you want to go through and you want to input all of the values of your assets and your liabilities. So I went through here, I typed in what the interest rates earned were on all of my all of my assets, what my rate of return since inception has been on all of my investments. And then over here, I laid out all of my debts, right? What are the interest rates on my debts? How much am I owing, et cetera, et cetera. Now, once you have filled this out, the next thing that you can do is you can analyze this net worth tracker for opportunities. In this example, it's evident that I have a lot of high interest debts that I'm struggling with, right? Now, once again, this is not my net worth statement. I'm just going to use myself as the client, for example. So what I really love to do one of the first things that we do with clients and coaching is we analyze their net worth tracker because we typically find that there are quick fixes that we can see just from the net worth tracker alone. So as an example, you could see before, let me actually just go back one slide. So you could see before here, I've got money in a TFSA. I've got all these high interest debts. I've got this comic book collection down here. Well, I would say to a client like, hey, you've got this TFSA. It's not making you more than the interest that you're paying on all of your debts. And you've got this huge comic book collection and you just told me that it's collecting dust up in your attic. So could you sell some of your comic books and liquidate your TFSA to get, to put down a big chunk of money onto your credit card, right? Because when you're in debt, you need to be laser focused in order to get rid of that debt. You're not going to be in debt forever, hopefully, if you practice the principles that we teach in Enriched Academy. We've seen people get out of so much debt over time. It's insane. But there's ways to get out of it, right? You just have to be laser focused. So once you've filled out your net worth tracker, then you take a look at it, analyze it for quick fixes. Once you kind of have it all figured out, the next thing that you want to do is you want to log your net worth for your month. So what you're going to do is you're going to click on the historical net worth tab. You're going to click the log net worth button, and then it'll log that net worth for the month. Now, you should do this every single month, especially if you are dealing with debt. It is really important and also very motivating to do this on a monthly basis. So make a calendar reminder on your phone on how to go about doing that. Now, when we start to analyze this current net worth even more, there's an even better way to get rid of our debts faster. And it's by consolidating everything onto a lower interest rate debt. Now, I want to talk to you about debt consolidation a little bit more detail. So, what is debt consolidation? It's the principle where you use a new loan to pay off a number of loans and debts. Now, some advantages are that it brings debts together into fewer loans to simplify finances and make your debts more manageable. It also typically saves you money in interest charges when you consolidate it into a lower interest rate loan. Now, this doesn't always work. It's really important that you read the fine print of the loan that you are taking off, because there are sometimes weird stipulations in these loans that we have seen before where, the way that they compound interest doesn't actually make sense for them, even though the interest rate seems lower than what it is. Now, let's go through some of the disadvantages. Some people who consolidate their debts will be in a worse off situation financially because they will spend more money on those debts that they've consolidated when they don't monitor their spending. So debt consolidation can work for a lot of people, but it is crucial that you track your spending so that you don't overspend again, right? Also, some consolidation loans have very high interest rates of 25% and above. So it ends up costing a lot more money in interest charges. So I suggest, if possible, stay away from the high interest consolidation loans whenever you can. Now, there are also a couple of different types of debt consolidation, and I'm going to go through each 5 of these right now. These are the 5 main ones. You've got your home equity line of credit, a personal line of credit, a debt consolidation loan, a balance transfer to low interest rate credit cards, or a debt repayment program. Now, always remember, read the fine print. Let's start with a home equity line of credit. Very popular right now. So a home equity line of credit typically comes with a variable interest rate, which means that it can fluctuate from month to month. So let's start by looking at the advantages. When you use when a home equity line of credit, I call it a HELOC, is set up, the funds are easily accessible and you only pay interest on the amount of money used. On top of that, a home equity line of credit offers much lower interest rates as the loan is secured against the house, against your house, which provides the lender with collateral. I'm seeing mostly with our coaching clients who have a home equity line of credit, the rates are around 2.95%. So if you've got very high interest credit card debt at 20% and you own a home and you've got equity in that home and you think you could consolidate your debt onto a home equity line of credit and have a budget and have a plan to pay it off in time, this is a really great strategy for you to use. So those are the advantages. Now let's look at the disadvantages. One of the biggest disadvantages is a possible foreclosure. Now, I can tell you that if you're monitoring your cash flow and you're being mindful about where your money is going and what you're spending your money on, this likely won't occur to you. But basically, taking on a home equity line of credit is like having a second mortgage against your house. Now, because your home is secured as collateral, if you default or are late on your home equity line of credit payments, you could lose your home. Another problem with the home equity line of credit is that you have the potential to rack up more debt because many homeowners might take out a home equity line of credit to pay off high interest credit cards. But then what happens is they just rack up their credit cards again, right? They're just kind of, what's that terminology? Paying Peter to rob Paul, or you're robbing somebody to pay Peter. I don't know what it is. But anyways, you need to have a plan in place, right? So let's look at a situation where you could leverage some equity out of your home to pay off your debts. Let's say you get your house appraised. And if you are a homeowner right now in Canada, it is, I would say, I would say 95% of the clients who come into coaching, I try to get them to go to the bank and get an appraisal on their house if they're going to use it for some kind of investment opportunity or to pay off their debts, right? It's a really good timing opportunity to do this because the housing market has exploded, right? So everybody's value of their home has gone up. You're continuing to pay down your mortgage. Now you've got this extra equity in your home, right? So let's say you get the appraisal value of your home, it's $500,000. The total percentage that you can refinance is 80%. Now, if you have a mortgage limit of $300,000, the maximum refinance limit that you can hit would be $400,000, right? 80% at 500,000 is 400. You've got a mortgage left of $300,000. So the total home equity line of credit available to you would be $100,000. Now, let's look at a personal line of credit. And we're going to use this number a little bit later when I actually show you a mathematical scenario on how much money you could save. The second type of debt consolidation is through a personal line of credit. This is offered as a secured or unsecured loan from banks and credit unions. Now, these types of loans also typically come with variable interest rates. That basically means that when Bank of Canada increases interest rates, which at some point will happen, you're going to start to see your personal line of credit interest rate increase as well. Some of the advantages of a personal line of credit is that they are flexible and often come with lower interest rates than credit cards. And on top of that, you only pay interest on the amount of money used. Some of the disadvantages include that people who have access to these funds are often tempted to spend it on unnecessary expenses. And as I said before, the interest rate fluctuates with the Bank of Canada rate. Now, the third is a debt consolidation loan. This is a secured or unsecured loan that is issued by banks, credit unions, and finance companies. And basically, your interest rate is determined by your credit score, and if you have some collateral to support the loan. So some of the advantages of the debt consolidation loan is that they consolidate all of your loans into one monthly fixed payment, which will help a lot of people simplify your finances. We find when people come into coaching, if they have a lot of debt and their debts are all over the place, sometimes it's good to just consolidate everything into one loan because it's easier to manage that way. Now, one of the disadvantages is that you could rack up debt again on your other loans. It could take longer to pay off those debts, and these consolidation loans sometimes come with very high interest rates. The highest interest rate I've ever seen has been about 35%. Obviously, I got that client to tackle that debt very quickly, and it helped them get out of debt actually once and for all. Now, the fourth type is a balance transfer credit card. So let's look at some of the advantages of this. First, you're going to save a ton of money in interest charges, which will allow you to pay off the principal amount much faster than you ever could. These types of credit cards offer a promotional low interest rate if you transfer a higher interest rate debt over to their product. Now, some of the disadvantages are that these promotional cards often come with a fee, and you have to read the fine print because this fee can typically be between 1% to 3% of the total amount that you're transferring over. Also, sometimes when the promotional rate is over, the credit cards will actually kind of bump you up to an even higher interest rate than some other cards have been. So here's an example of a low interest, no annual fee credit card. Basically, you know, those credit cards that offer you promotional points when you first start with them. These are those kinds of, promotional credit cards. They will give you a credit card. The promotion is that they offer 0% interest or a low interest amount for a certain amount of time. That's their promotion, basically. So these cards can work as a strategy to getting out of debt. But once again, you have to be managing your finances. You have to be managing your cash flow and have a plan as to how to get rid of this when that promotional period is over. Now, let's take a look really quick at the amount of, let's take a look at this math. If you're approved for a balance transfer card, you could save, at $20,000 credit card, normally at a 20% interest rate, you'd be paying $4,000 in annual interest payments. If you transfer it over to a balance transfer card, 0%, you pay no annual interest payments. Just remember that that transfer fee is not included in this calculation. So if you had, $20,000, you'd have to figure out if you were transferring it, what the 1% to 3% would be. But you're still saving a lot of money in interest charges to that the credit card company. Now, as I mentioned, they're great short-term if you have a long-term plan. Now, the fifth type of debt consolidation is through a debt repayment program. So this would be something such as a consumer proposal, debt management program. And these types of programs should be used as a very last resort. This is a legally binding contract with the Bankruptcy and Solvency Act where you settle your debts with creditors for less than what you actually owe. Some advantages of these are that these types of repayment plans freeze your interest rates. Your debt payments are consolidated into one affordable monthly payment to ensure that you are debt-free within 5 years, and you'll receive immediate protection from creditors. So creditors will stop calling you. However, it will negatively affect your credit score. And it only covers unsecured debts like lines of credits and credit cards. So it won't cover secured debts or government debts. So if you were to go through a consumer proposal or a debt management program, you have to see what the terms are, because it's going to be very difficult until the terms of that program is up that you are actually going to be able to increase your credit score. Please only use this as the last resort. Here's what not to do. Don't use these forms of debt consolidation to free up other debts and then rack up those old debts again with assets that never appreciate. So don't put money on your home equity line of credit and then pay for a trip to Thailand on your credit card, right? It's not a very smart thing to do. Okay, so let's take a look at this example. Going back to my net worth tracker, right? Because I've just talked to you about the different forms of debt consolidation, and I want to talk to you now about looking at my net worth tracker. So the biggest change is what you're going to see is actually over here. In our net worth tracker, we break down how much interest you're incurring on a monthly basis or on an annual basis if you were to continue using those debt vehicles. So let's say here, I have all of these high interest credit card debts, right? And I'm paying about $3,582.28 annually. Now, that is a simple interest calculation. It is actually much, much higher than that because credit cards charge interest daily, right? At the end of every single day, not annually. So this is just some very simple math as an example purposes. However, I have a home equity line of credit down here that I hadn't even thought about using, which I'm now going to consolidate all of my high interest debts onto my home equity line of credit. And now I'm only paying $964.53 annually in debt. So let's just break this down. Super easy. How much am I saving? $2,617.76. That is just by consolidating my debts. That is an opportunity of an extra $2,617.76 in my pocket that I'm no longer paying to the credit card companies that I can now apply to the principal amount owing, right? All you would do basically is you'd start to pay off your home equity line of credit that much faster. Now, once you've had all of your debts organized and you've thought about other opportunities on how to get rid of your debts faster, you can now organize your net worth tracker on which debt to focus on first. Now, we do this using the Debt Avalanche or the Debt Snowball method. So the first thing usually that you want to do when you have debt is look at debt consolidation if you can. If that is not an option for you, then you either want to go through the Debt Avalanche or the Debt Snowball method. So let's talk about the Debt Avalanche method first. So with this method, you're going to organize your debts so that you focus on the highest interest rate first. You're then going to determine how much of your income you can allocate against your debts on a monthly basis. You're going to commit to this amount every month until all of your debts are gone. Now, if you have debts with a fixed payment, continue to pay these on a regular payment and don't include them into this Debt Avalanche method. Make the minimum payments on all of your other debts. So you're just going to focus on one debt at a time, and it's going to be the one with the highest interest rate. Once the highest interest rate debt has been paid off, what you're going to do is you're going to take those monthly payments and you're going to apply it to the next highest interest rate debt. And you're going to continue this method until all of your debts are paid off. Some of the advantages of using the Debt Avalanche method is that it minimizes the amount of interest paid, and it also reduces the amount of time to get out of debt if you have large amounts of debt. Now, some of the disadvantages is that it takes discipline and commitment, and it can also be very frustrating when you're focusing on the highest interest debt if it also has the highest balance. So let's take a look at our net worth tracker again and how we would organize our finances if we were going through the Debt Avalanche method. So let's say I've gone through my budget, I've kind of, worked out my cash flow, what are my necessities, where are my financial goals, and I've committed every month that I can take $700 of my income and pay it towards my debts. So if we're looking at my net worth tracker, the very first debt that I want to focus on is this PC Financial MasterCard here, right? It's the highest interest. It also is the highest debt. This would be the second one, the World Elite credit card. Then I've got my Scotia Value Visa. That's the third one I'm going to focus on. And then down here, this is the fourth one. So these would be my minimum payments here, right? I'm just going to figure out on my credit statements, what are my minimum payments? That is going to leave me with an extra $205.75 a month, which I'm going to commit to paying that PC Financial MasterCard every month. That is the minimum amount that I'm going to put on that card. So what is then going to happen basically is once you have paid off this card in full, and keep in mind also, you're going to try to not spend more money on these cards, right? You got to put these cards away if you are in debt and you're doing this method, because you can't just keep racking up this debt on these cards because it's not going to work that way. So once this debt is completely gone, this 205.75, and this credit card is at zero, freeze that card. I don't care what you do with it. But then what you're going to do is you're going to take your $205.75 and you're going to apply it on top of the $72.46 per month that you were paying on the BMO World Elite MasterCard. You're going to keep doing that until this card is gone. Then you're going to take these $2 amounts, put it on the third card, pay that. So now all of a sudden here, you're paying about $500 a month on this credit card, right? And then at the end of that, you're putting $700 a month onto this personal line of credit. And then you'll be debt free, except for these other student loans and car loans and all that other stuff. That's how the debt avalanche example works. Now, let's talk about the debt snowball method. This is where you focus on the smallest debt first. So it doesn't take into consideration any interest charges. It's the smallest balance. You're then going to determine how much of your income you can allocate against your debts on a monthly basis. And you're going to commit to this every month until all your debts are gone. You're going to make your minimum payments on all of your other debts. And once the smallest debt has been paid off, you're going to take those payments and apply it to the next smallest debt. And you're going to continue this until all of your debts are paid off. So very similar to the debt avalanche method, but this focuses on the smallest debt first. Now, one of the biggest advantages of the debt snowball method is that when you have smaller debts, it's very motivating for people to pay off smaller debts first. And so they want to keep, they get all jacked up because they're like, I just got rid of one of my credit cards that had $500 on it. I'm super excited. And then they just keep wanting, it just keeps snowballing. And it seems more manageable for them to pay down debts when there are fewer of them. One of the disadvantages is that you do sometimes end up spending more in interest payments. Now let's take the same scenario. I have a commitment of $700 per month towards my debts, but here the only difference is I'm going to be doing this a little bit different, where I'm going to put most of my money every month towards the BMO World Elite MasterCard. It is the smallest because it's the smallest balance. So this is my net worth tracker now. You can see I went with I've consolidated all of my debts here. This is an example. I want to focus first on my personal line of credit, and then I'm going to focus on the home equity line of credit. And that's basically one of the best ways to manage your debts moving forward. Now, there's also another webinar that I do on budgeting, right? That is part 2 of this whole debt consolidation and managing your debt and getting your credit score up, is managing your cash flow. But I'm not doing that today. I think I've got a webinar coming up in a couple of weeks, so stay tuned because I will talk to you about managing your cash flow and creating a budget. But what I would like to talk to you about right now is our one-on-one financial freedom coaching program. Now, as I mentioned, I've been with Enriched since October 2017, and we have a system that works. Our financial freedom coaching program, we've coached over 600 people in Canada, and it's been an incredible journey for them over the 6 months to see how their financial mindset and just their actual finances have shifted over time. Now, the number one cause of stress for Canadians, 38% said it was actually money. And 70% of Canadians don't have a retirement plan and think they won't be able to save enough for retirement. Now, the biggest problem here is that Canadians are not able to pursue goals and passions because of the lack of money. They feel stuck, they feel trapped, and they feel hopeless. And that's why we created our financial freedom coaching program. Now, what can this program do for you? Basically, what we do, our program is like a GPS system, right? If you have financial goals, I just went too fast. If you have financial goals it should be like a GPS system, right? You have a starting point of where you are right now and where do you want to go. Most people have financial goals, but they have no idea to get from where they are right now to where they want to be down the road. And that's what our financial freedom coaching program helps you achieve. Now, if financial freedom coaching right for you, do you need help taking action? Do you want a financial expert to help create a plan for you? Do you want to create more financial security for your family? Do you need accountability and guidance from a financial expert? And if you said yes to any of these, I would highly suggest signing up for the free financial assessment call that we're going to be offering. But first, I want to go through some of our coaching results, and these are as of June of this past year. Now, you're all here because you want to learn about your credit score, right? And you want to make your credit score better. Our average coaching client sees an increase in their credit score by 28 points. We've actually had about 4 or 5 clients who currently have perfect credit scores. I've never seen it before in my life. I've seen about 3 or 4 personally that I've been working with that have about a 900 credit score. Some are up around the 899s. They didn't come into coaching with that kind of credit score. I can tell you that. The increase in net worth that our coaching clients see is just shy of $50,000 over a 6-month period. We're able to save our clients 1.25% in fees annually. And that is an annual, that is just a forever growth. We help clients decrease their monthly spend by $1,214.52 every month. And we've helped clients decrease their credit card debt by $3,574.63. Now that's over the 6-month term. Now, why financial freedom coaching? We're the #1 program for results. Not only that, you're going to see fast results, right? Our program is only 6 months long, and the 6 months that you take in this program is education that you are going to have forever. This is not an expense, right? It's an investment in yourself. We provide the enhanced accountability. Most people who come into coaching need that accountability. They haven't been doing it themselves. They need to have those one-on-one sessions with their coach to, light a fire under their tushies. And so they really enjoy the enhanced accountability. We offer 100% bias-free financial experts. We are all financial coaches. We do not sell any products. We are out for your best interest, not the best interest of, the companies out there that we're selling products, because we don't sell products. We are just in it for you. It is a life-changing opportunity for you to be better with your finances, and the return on investment is by far one of the best in Canada. I actually just worked with a couple of police officers out in BC, and they left me this crazy awesome testimonial about just how this was the best program that they had ever taken. These are police officers, right? They make a good income. They have good pensions. They just knew, they didn't know before coming into coaching how much more efficient and effective that they could be with their finances. Now, here's a testimonial from one of our recent clients. Actually, this is Sandra. She's out in Quebec City. I just wanted to highlight this out here. She increased her credit score by 38 points, and her overall net worth increased by 694.08%. Now, that's a very high increase in net worth. I'm not saying Sandra did not do amazing, but she was an intense saver, and then we taught her how to invest, right? And our coaching program is going to be different for everybody. But basically what we're going to do is we're going to help change the system that you're currently in. So Warren Buffett says you will work until the day you die unless you learn how to make money while you sleep. This is exactly what we do in coaching. We take your earnings and we're going to fix your system, right? If your system is broken, if you are living paycheck to paycheck, if you are constantly in debt, if you have no idea how to get out of this debt, we need to break the system. So this is what we do. We take your earnings and we have those earnings eventually help to make assets, right? And these are income producing assets that create passive income. And then this passive income is going to help to build and fuel the lifestyle that you want, right? Imagine going to bed every single night, knowing that you have money coming in and not having to leave the door in the morning to go to work, right? Because you're not trading time for money. You're just being more effective and efficient with the money that you have right now. So ask yourself this: in 20 years from now, what will your life look like if you don't learn how to manage your money now and create passive income? So we are going to offer a one-on-one financial assessment call. This is a free 45-minute call. And I want to help you jumpstart your journey to financial success with this call. It's completely confidential. It's a one-on-one call with an Enriched Academy financial freedom consultant. And they go through a 4-step approach. The first step is they're going to evaluate your financial situation. You're going to receive an unbiased, straightforward, trustworthy evaluation of your finances. Then they're going to identify the root causes. They want to uncover the source of any ongoing financial issues, right? We need that in coaching. Your coach is going to work with you through that too. Why do you have these root causes? What made you get into debt in the first place? Why do you want a better credit score, right? Why do you want to, save for a house? We need to figure out what these root causes are. The third thing is they're going to set goals, help you set goals for your future. Your financial freedom consultant is going to discuss realistic financial goals to be financially secure now and into retirement. And then the fourth is they want to design your path forward. So they want you to learn your options and receive personalized guidance on next steps. We have some clients who come into these financial assessment calls and, we find that they don't need any of our products, and that's totally fine. They just have a better understanding of where they are right now and what they should be doing moving forward. So make sure that you secure your spot. We're going to have our marketing guru, Mark, put a link in a chat box, either on YouTube or in Restream or wherever we are filming this right now. I'm not sure. Well, I do know, but he's gonna do that. So take a look at the chat box. There's going to be a link in there on how to sign up for your assessment call. Please make sure that you add the time and date to your calendar. We only have a very limited amount of spots, so please make sure that you sign up for those spots. And please go through, if you want to jump in with your partner and spouse because they're really interested in coaching, please bring them in. We love coaching clients with, partner and spouse inclusion. We get a lot of clients who come into coaching who have, the partner and spouse that comes in, and we love that. We love hearing about your story. We've helped a lot of clients who have been able to, just better their overall financial situation because they never talked about money before. So whether you are, married, single, newly divorced, widowed, we can help you. Let us help you. Okay. So let's take some questions. Sorry, I'm just back on this Restreams thing. So, a lot of people here. That's really cool. So do we have any questions about anything? Let me just see where everybody's coming from again. Saskatoon, Vancouver, Spruce Grove, Vancouver Island, Mississauga. But what is a good score? Okay, so what is a good score? So a good score typically is between 700 and 800 is usually what they deem to be a good score, and anything above 800 is excellent. Is it possible to get this presentation slides? No, sorry, Jen, we don't give out the slides just because it's our content and we're constantly developing it. We don't want it to be shared. But I believe there will be a re-recording of this webinar. Could 2 credit cards used wisely have a more positive effect on your score than just 1 card? Yes, Eric Roy, I believe it can. And this would go back to, I guess it depends. If you're maxing out both credit cards, no. But if you have, I guess there's a couple of different scenarios on how you use your credit, right? If you've got a credit card and it's $1,000 limit and you're maxing it out every single month, you're making your payments on time, et cetera, et cetera. Let's say you go out and you get another credit card, your credit score will probably have a negative effect within that first month because you've had to apply for new credit, right? Now, in saying that, if you took the $1,000 that you were maxing out and you split it half and half, it would get your credit utilization rate to 50% on each, right? Not 100% on one. So you'd probably see your credit score increase over time that way. So long as you just weren't maxing out each of your credit cards, I think you should be good long term. We're boomers. Sil S2319 says we're boomers. We don't know who Nicki Minaj is. It's Nicki Minaj, and that's okay. But anyways, that's beside the point, but that made me laugh. Are we able to get a copy of the tracker? So if you are part of Enriched Academy, the tracker is online. If not, I bet you could Google search and just find a net worth tracker. I'm sure there's even an Excel spreadsheet. If you have Excel or Google Drive, there's tons of net worth trackers out there. We just have our own online. So we only offer that to Wealth Mastery clients. If someone has several credit cards, how is their score affected if they were to close some out, or should they keep them but not use them? Yeah, Denise, this is a really interesting question. So, um, you have to look at a couple of things, right? Once again, why do you need a good credit score right now, right? That's, I think, the first thing. I'm not saying like throw your credit cards like, out the window, but you have to really figure out like how good of a score do I need to get whatever I want down the road. Uh, Try to not get rid of your longest credit card used, but also take a look at, what are the fees that you're incurring on your credit card? Is it, are you paying $300 a year for a credit card that you don't use? Yeah, then you should probably cancel it. Or if not, cancel one of the other ones. And use that instead, right? You got to look at the payment history and the credit utilization on all. So it's really just about your specific situation and what you need multiple credit cards for, if anything, and then trying to keep the one you've had the longest outstanding time with. Safest way to check your credit score, Bruce, you can do this, like I said, through those banks. TD is actually one of the major ones that doesn't do it at this point. If you don't bank with any of those major banks, you could take a look at like a Borrowell or Credit Karma. They're not going to be exact, but if you want one of the free ones, Credit Karma or Borrowell are okay. If I have a very good credit score, how will I know that the lender use it to give me the lowest rate? Jay, I don't think you actually will ever know if the lender is going to give you the best rate. I've seen some client, and this is the thing with like the rate shopping. Sometimes you got to do it for the best rate, and sure, it might affect your credit score. But I had a client once who had been had her mortgage with TD for a very, very long time. Great credit score. They went to refinance their mortgage. They only got approved, I think it was like 1.89%, and then ended up going to RBC, and RBC offered them a fixed rate at 1.43%, and they'd never banked with RBC before. So it's you never know what the lenders are going to give you. Unfortunately, just have to do some due diligence. What's the best and fastest way? What's the best and fastest way to improve your credit score after you did a consumer proposal? So if you've done a consumer proposal, like I said, it's going to take about 3 years for you to see any kind of increase on your credit score. In the meantime, practice everything that we just went through. And it's once you are done, once that consumer proposal or the bankruptcy is out of the way and you've served your time, you're going to see your credit score increase. I can almost guarantee you that. Yes, this will be recorded later. Is there an average credit score that is widely accepted by credit card companies? I don't know, Eric. That's a good question. Now, there are some specific credit scores for people who have very low credit scores. And I've seen, we've had clients who have come into coaching before and they're like, I can't get a credit card. And there are some of those credit cards that they're more like a debit card, like it'll help you rebuild your credit. So it's kind of like a prepaid Visa, let's say, right? That you sync it up to your debit card, you put $1,000 on it, widely accepted where Visa is, and you use it like a credit card and you can help to rebuild your credit. So, it kind of depends. I don't know what the average credit score is, though, to be honest. Now, you could have a really crappy credit score and get a credit card, but your interest rate's 30%, right? I've seen that before as well. I will be debt-free this year, credit card completely gone. Is there anything else that I can do to improve and increase my credit score? That's awesome, Troy. If you're good with managing your debt, and managing, keeping a budget, or at least just like not overly spending. As I said, opening up another credit utilization or credit vehicle, if you have a mortgage or car loan or a line of credit, and just showing the lenders that you are diligent and responsible with how you deal with credit, that is going to help with your credit score. Question from Colleen. The credit score checkers through your online financial institution bank, is that still a soft check, even though it is provided through the bank platform? Yes, it's still a soft check. You can use that as much as you want. Is the fee for coaching applies to the couple? Yeah, we have a straight fee for coaching if you are a couple or if you are single, but it's just a straight up fee. How long does it take to recover from a hard check on your credit bureau? Denise, I actually don't know that question, but I mean, I think if you were to look for a credit, I think if you were to look for a new credit card, for example, you'd probably in that first month when the credit bureaus do the check, like when they update their system, it'll probably be affected in that first month. But if you are very responsible after that, I don't think it would take a very long time to rebuild your credit score. I can tell you, most of our coaching clients in coaching take on good debt, right? We get them to increase their home equity line of credit and do all these things. And they see their credit score decrease a little bit, but by the time they're done coaching, it's back. It's like way higher than what it was before. So I don't think it takes that long to rebuild. I use Credit Karma. Where's the best place to get the most accuracy? Yeah, so Anita, Credit Karma and Borrowell, although they're great and they're free sites, really what they're doing at the end of the day is trying to sell you products. I don't know if you've ever noticed, but I signed up for Credit Karma a couple of years ago just to kind of see what it was like, or was it Borrowell? And now I'm like, oh, you want me to get this credit card or this credit card or this credit card? The most accurate place to get it is through TransUnion or Equifax. Those are the only two. Steve, I already completed the initial interview a while ago. I wasn't ready then, but I am now. Who do I call? So yeah, Steve, sign up for that free assessment call that is in the chat box here. I actually saw that Mark put it in here. The link is pinned to the top of this chat. It's this book your free financial assessment call here. I hope you can all see it. How often are credit scores updated? I apologize if you've already answered and missed it. Nope, I did not. I didn't look. I didn't see that. I believe they're updated monthly. Credit scores, yeah, you'll have a new credit score every single month. It's not a weekly thing, but it happens at least once a month. I can't tell you the exact date, but if you were to look at your credit score today versus what it was or in like a month from now, it's probably going to be different. Yeah, so I think that's it. I don't see any other questions here. Did anybody have any other questions before the end of this? So please, for all of you, thank you for coming today. It was really great. I don't see any more questions coming in. So for those of you who are on here, please sign up for an assessment call. They're really great. You'll talk to one of our financial freedom specialists. They are patiently awaiting your call. We have one more question from Z. If your debt is with a collection, agency, can you have a way for paying it without consumer proposal? I believe you can. Yeah, I believe you can get a hold of the collection agency. You'd have to double check, but I'm pretty sure you can get a hold of the collection agency and actually just say, I have a way that I want to pay for this. I think. I'm actually not 100% sure of that question. Of that answer, I should say. But I would start first by calling the collection agency and asking them, because there should be a way without going through a consumer proposal where you can do it. Oh, Lori, right. I did see this, your question. The card was canceled because HBC stopped using that particular creditor. I heard this negatively affected my credit rating, even though it was out of my control. Yeah, I think it does, unfortunately. Even though it's out of your control. Yeah, I think it does because they have to cancel that card, even though nothing that we can do about it. I also once had a credit card that I used for traveling, and when I came back, they'd shut down the credit card, and it had a small negative effect on my score, but it was still a negative effect. Christina says, if I ask for an increase in line of credit, will it lessen my credit score? I'm at 800 score right now. Yes. So if you ask for an increase in your line of credit, if you call the bank and you ask them for an increase, it will have a negative impact on your credit score. It won't be there forever if you're going to use that credit limit wisely. Now, if you're at an 800 score right now, that's great. What do you need your credit score for, right? If you don't need a good credit score because you're not taking on more debt or you're not applying for a mortgage or a car loan or anything else like that, an increase in your line of credit, if you're asking for an increase in your line of credit, it'll have a negative impact on your score. If your credit institution reaches out to you and says you are able to increase your credit limit and they're offering it to you, take it. I don't think that affects your score. My credit score through my bank shows an open credit card with an amount available. This card has been closed for years, but is this reducing my credit score and how do I remove it? Yes. Yeah. Check your credit score, people. It's a very real thing that there could be errors on it. And so the first thing that you would have to do is this actually happened to me a couple years ago. I had a credit card that was showing on my credit report that I had not had in years, and it was still showing as open at HSBC. Whoever I called originally hadn't actually closed it, and it was sitting with a zero balance, but it was still there. So I had to call the company. They had to look up my credit card number, which I hadn't had in like however many years. And then from there, they had to basically then close it. So that's the way that they go about doing it. Okay, I've got time for one more question, then I have to go because I actually have a client meeting in about 10 minutes. Since I have Lori, I did answer that question. I don't know how often they're at least updated once per month, your credit scores. I don't know when, but it's at least once per month. Since I have an old departmental credit card with no balance, is it then wise to keep it open for better credit score, debt balance ratio, or close it? Omar, if you've had an old credit card that has been open for like 10 or 20 years, even if you don't use it, that's the length of credit history that's probably impacting your good credit score, hopefully. So it's actually wise to keep it open and use it if you can. But yeah, I mean, it's up to you at the end of the day how many credit cards you want to have open. Okay, everybody, I have to run.